Markets appear to be banking on a soft landing for the US economy.
Are you starting to think that a soft landing is a real possibility?
Soft landing? Yes, no?
A soft landing means lower inflation, a minimal increase in unemployment, and economic growth for the rest of the year. You're seeing these expectations in stocks, bonds, and even in crypto. But there's one market where these expectations could really unravel that soft landing thesis: currencies. I'm going to show you what we're seeing in markets, explain the role the dollar has played, and break down why a weaker dollar could reverse a lot of the good news we're seeing. Let's get into it. Markets have been rallying since mid-June and got a big boost from July's Consumer Price Index report that showed lower than expected US inflation. Tech stocks and meme stocks have boomed, along with junk bonds and cryptocurrencies. Those are all signals that investors are bullish and look to be pricing in a stronger economy. These bullish expectations have also caused a notable decline in the value of the US dollar, which rose to a 20-year high in June. The dollar rose as currency traders priced in aggressive action from the Federal Reserve and other central banks that looked like it could cause a global recession. A weak global economy benefits the dollar because it's the world's reserve currency, and it's sought during times of instability. But with inflation's decline, along with falling gas prices and rising consumer sentiment, traders are reversing those bets. The Fed is now expected to raise interest rates by less this year and to begin cutting rates next year, even though Fed policymakers have said that is not their plan.
What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that.
It's worth watching the currency market because the strong dollar has helped keep US inflation from jolting even higher. A stronger currency means imports cost less, and the US has been importing a record amount of goods since the pandemic. In fact, the growing US trade deficit was a big part of the negative GDP growth we've seen in the first 2 quarters this year. US companies made more complaints about the strong dollar hurting their earnings during the second quarter than they have at any time since 2015. A weaker dollar would put upward pressure on the prices Americans are paying, and could also increase the price of commodities like oil, wheat, and copper. That could be good for the stock market, but bad for the overall economy, because a weaker dollar means rising prices, which of course means rising inflation. And the decline in inflation is at the center of the soft landing expectations we're seeing. I made a video about how the dollar impacts prices in the economy back in January. Check that out if you want to learn more. Even if inflation doesn't rise meaningfully, if it holds above 8%, where it's been since March, that could cause some headaches that markets don't seem to be pricing in. Watch the markets like Detroit rapper Big Sean, who says, "Success is my idol. Being broke is my rival. But it's cool, because I've got the title." That's all for now. I'll see you next time.